Did you know that depreciation is one of the most powerful tax benefits real estate investors can use to reduce taxes? But when you sell your property, you'll most likely face depreciation recapture, and if you're not careful, it can cost you big time. In today's video, we're going to explain what depreciation recapture is, how it works, and most importantly, a powerful tax strategy you can use to avoid it. Stick around because this could save you a lot of money in taxes. Hi, my name is Thomas Castelli, and I'm a tax strategist who helped hundreds of investors keep more of their hard-earned dollars in their pockets and out of the government's by using the tax code to their advantage. Before we dive in, remember to like, comment, and subscribe so you don't miss out on future tax savings videos. Before we get right into depreciation recapture, let's quickly go over what depreciation is. As a real estate investor, the IRS allows you to depreciate the value of your property over a period of time, even though it might actually be increasing in value. This means you can write off a portion of the property's value against your income each year, reducing your tax liability. For residential properties, the IRS allows you to depreciate your property over 27.5 years, and for commercial properties, it's over 39 years. The bottom line, depreciation can save you thousands or even tens of thousands of dollars in taxes when you own the property. But as the saying goes, all good things must come to an end. And when you sell your property, the IRS expects you to pay some of those tax savings back in the form of depreciation recapture. And this is where things get a bit complicated. Depreciation recapture is a tax on the amount of depreciation that you've taken on your property over the years. In other words, the IRS is essentially saying, hey, we gave you this tax benefit while you own the property, but now that you're selling it, we want our cut. Now, depreciation recapture is taxed at a maximum rate of 25% for the building portion, but if you use accelerated depreciation, it could be up to 37%, which is generally higher than long-term capital gains rates of 15 to 20%. So for example, if you've taken $100,000 of depreciation over the years, you could be facing a $25,000 tax bill or more just on the depreciation recapture component. So how can you avoid depreciation recapture? Well, the answer lies in one of the most powerful tax tools available for real estate investors, the 1031 exchange. The 1031 exchange allows you to defer both the capital gains and depreciation recapture taxes when you sell a property, as long as you invest the proceeds into another investment property. Essentially, you're trading one investment property for another and kicking the tax can down the road. Now, the beauty of the 1031 exchange is there's no limit on how many times you can do this. You can keep rolling your gains and depreciation recapture over, indefinitely building tax-deferred wealth. Now, you do have to follow some strict rules when it comes to using the 1031 exchange, such as identifying a new property within 45 days and completing the exchange, so buying the next property within 180 days. But if you do this correctly, this can save you a ton of money in taxes. Now let's break down some of the tax benefits. First, you're deferring your capital gains taxes, which means you're keeping more of your money working for you rather than giving it to the IRS. Second, you're avoiding the dreaded depreciation recapture tax, which can easily amount to thousands of dollars in taxes. And finally, you'll continue to compound your real estate portfolio by reinvesting into a larger or more lucrative property without the immediate tax hit. Now, I know what you're thinking. Does this tax bill ever come due? And yes, it eventually does if you sell the property without doing another 1031 exchange. However, if you continue to use 1031 exchanges throughout your life, you can defer these taxes indefinitely. And in some cases, your heirs might receive the property at a stepped-up basis when they inherit it, effectively eliminating the tax bill entirely. So to recap, depreciation recapture can be a nasty surprise when you sell your investment property, but there are strategies to avoid it. By using a 1031 exchange, you can defer both the depreciation recapture and capital gains taxes, allowing you to keep more of your money working for you. If you're thinking about selling your investment property and want to avoid a huge tax bill, the 1031 exchange might be the perfect solution. But it's crucial to consult a tax professional to ensure that you're following all the rules to maximize the benefits. If you have any questions, go ahead and drop them in the comment. And of course, hit that like button, that subscribe button, and that bell icon so you don't miss out on future videos. We'll catch you